And Wendy, I think this is going to be a very interesting time for us as real estate agents, especially in Canada. We're a little different down here, but right now you're rolling into a buyer's market.
Mhm.
But I think there's going to be a very short window on that buyer's market just because there's such incredible demand for property.
Yeah.
So as a buyer's market, you've got this opportunity to say, hey, listen, you might have to lock in at a percentage or two higher than you would have liked to, but your house value is lower than what you would probably pay 6 months from now. Because we're going to see, as soon as these rates begin to get down a quarter, a half, a full percent, we're going to slip out of that buyer's market and back into a seller's market very fast, and prices are going to go through the roof again.
Welcome to the Timbits and Tacos Real Estate Podcast with me, Wendy Pauls, and my good friend and fellow agent, Rick Parks.
No worries. How are the both of you?
Good. How are you?
Yeah, excellent. Doing really well.
I'll upset you both right now. It's 27 degrees and beautifully sunny, and I'm looking out at a lovely, calm Sea of Cortez out of my window.
I'm jealous.
That's why I say it.
He likes to taunt. Yeah.
I was just asking Wendy. I said, when are you giving up everything in Ontario and coming on down here and moving down? So
no kidding, right? I mean, I think a lot of us would love to do that right now. We'll see
Anytime.
how this goes. We'll see how this goes in this year, right? I mean, maybe there'll be an influx of people that are wanting to make that decision sooner than later, right?
It'd be nice.
Yeah.
Our market has been very slow.
Yeah.
We slowed down in May, and I mean, every agent I'm talking to is the same story. We're all, it's been a very dry 6 months for sure.
Yeah. I think it depends on. It's interesting because I got stats here. It depends on the area, but I think overall, like, we've been really hit in Ontario.
Yes.
And rightly so. I think we had such a drastic price reduction. It's definitely affected not only, I think, the volume, but it's affected a lot of people's mindsets, right? And just inflation right now is catching up. Like, it's definitely hurting a lot of people. So I think next year I'm really looking forward to it because I do think that there'll be a correction. I think it's going to be an interesting ride, though. So
correction in what?
I think we'll have a correction on rates.
Yeah.
Rates will come down drastically. So I think what the forecast has actually even changed from week to week and in the right direction. So the aggressiveness of rate reductions, I think we're going to see quite quickly. And
well, I think the U.S. rate dropped about 0.25% 2 weeks ago.
They didn't drop their Fed rate. They paused it.
Okay, but I saw something drop a couple weeks ago. Yeah, okay.
Yeah, their inflation rate came down. So that came down to 3.2, which was great. And then this morning in Canada, our inflation rate came in at 3.1, which was under market expectation. So that's a huge win for us.
Yeah.
So that forecast of that 2% target rate, we will see quicker than what the forecast was. And so when we're looking at interest rates overall, the biggest elephant in the room right now in Canada and why we're going to see this huge reduction on rates is this government didn't forecast enough and look at the stats of how many mortgages are coming up for renewal in Canada for the next 3 years. We have over 64% of mortgage funding that is going to be coming up for renewal in the next 3 years. And the payment shock that people are going to see, some of the stats are we're going to 2024 is going to be a hard one, but it's going to be actually, if these rates don't come down, 2026. I'm just trying to get my stats here. It'll be 2026 because the interest rates back in 2021 were sitting at about 1.5%. The majority of those mortgages. So you're looking at a 45% payment shock.
Yeah.
People won't do it. I'm telling you. And they said that, we're going to be, it's fun. It's interesting to listen to economists that forecasted the financial crisis in the US to what they're forecasting for us here in Canada. And they said that this government now has to do the right thing immediately Because if they don't, that financial crisis that they felt in the US is going to be nothing to what historically we're going to see here in Canada on this housing market.
So let me ask a quick question, only because I'm ignorant to the Canadian market at this point. What is a 5-year fix sitting at this point?
Well, interesting enough, we've had a rate reduction in the last 2 weeks. We've had about 50 basis points reduced on fixed rates. It's just the media's not talking about it, right?
Right.
Wins here. So, sitting at right now an insurable mortgage. So if you were buying with less than 20% down, you're looking at about 5.59. So
that's still not unreasonable numbers.
It's not, but you got to remember we're stress test, right? So that means
That's right. You have to go to
over about
7.5. Yeah.
So people aren't qualifying. Like to buy a house right now for 600,000 with minimum down payment. So you're looking at a little bit over 5% because we have that sliding scale for purchase prices over 500. You're looking at you need an income of at least 145,000. Like what single person or couple in Canada? Very few people are making 145,000 plus no debt, right? Like I'm talking no car loans, no debt. Like that's not realistic to Canadian individuals or couples right now. So we've priced out like over 50% of the market right now on buying homes, and why we're sitting, like we're just all sitting in this industry. Now, some people have done really well in this industry from a real estate side or mortgage side, but it just depends on what area you are, what your client base is. It's picking and choosing. It's not the majority of people, and we should be able to, as a country, still be able to afford home ownership. Like the stress test needs to be eliminated or adjusted, right? And this government isn't doing the right thing right now on that. So the best thing right now is these rates. They have to do the right thing, and they have to bring down rates. And the forecast is to see about a 2% reduction on bank prime. That's the forecast from financial advisors. That's the forecast from economists. But when you're looking at, like, I watch trading economics religiously, and that takes all the factors of GDP, like manufacturing numbers, business confidence, consumer confidence, the retail numbers. They're forecasting a 1% reduction in bank prime by the end of Q4 next year. So it's still going to be a bit stickier. And if you actually look at the US right now, their Fed rate, they're looking at, I'm just looking right now. So they're looking at a reduction. Yeah. Like they're actually not even going to look at that much. It's probably going to be about a half a point. Probably a half a point that they're forecasting. So this government's going to be a bit stickier on reducing that bank prime rate. I think where we're going to see it mostly is on fixed rates coming down, because the bond yields are going to come down as these countries end up in a recession, right?
If I'm coming into a renewal off of a 5-year fixed, what's your recommendation? Do I go into a month-to-month ARM scenario? Again, I'm using both American and Canadian terminology. Forgive me, but
no, that's good. So ARM, variable rate mortgage in Canada. You know what? It's a good question, and it really depends on the client situation. There's a couple of reasons. One is every situation is unique. Everyone's financial tolerance is going to be pushed right now because we've had 2 years actually of interest rate hikes, right? So a lot of people they're just done on their savings. Their savings is down to zero. They're already cash strapped because of just everyday life. So we have to look at these renewals very early on. Like I'm telling anybody in the next 3 years, you need to call now, because the payment shock that people are going to see, I need to make sure that they're realistic to what the worst case scenario is today, to have a better scenario down the road, but they need to be prepared. So depending on people's financial situation and their tolerance, and also how much they qualify for. So if you're up for renewal, you can, as long as you've made your payments on time, you've stayed in good standing with the lender you're in, you can be offered a renewal with your existing lender. So you don't have to re-qualify for your mortgage.
So you're not having to up-qualify to get that current.
Exactly. Now, that actual policy, the federal government was going to look at changing. So a lot of Canadians don't know this, but they were actually lobbying to change where we had to re-qualify as Canadians when your mortgage was coming up for renewal. Can you imagine?
Well, so you're living in your $400,000 home, $500,000 home, middle of nowhere for 500,000, but whatever. And all of a sudden your mortgage rates come up, you can't afford it, you can't qualify. What do you do with your house?
Exactly. So I'm part of the association with Mortgage Professionals Canada. We went lobbying at Ottawa and spoke to a lot of MPs, the housing minister, minister of finance, to say, okay, listen, like here's some actual stories of impact already in a market where we know majority of these mortgages aren't coming up for renewal. We have to look at this in a different lens. So not just our association, but they did a round table and they came back saying, okay, if you have an existing mortgage, you can qualify. You don't have to requalify at the time you're up for renewal with your existing lender or bank. So that's great. But here's where the problem is. It's still not allowing people options and choices to be able to get better interest rates or a different product that suits their needs for the next part of their life during the next course of their renewal. So if we can qualify them, so if a client can qualify because we can get them into a better rate or a better variable rate mortgage, then we can look at moving them. And so if they can tolerate a variable rate mortgage right now, it's actually in their best interest to take a variable rate right now, because rates are coming down. Like we've reached that top of the hill, I say, right? Like we're at that top now. And the good news is we're coming back down, but we can always see in cycles. Like I can show you historically, there's cycles that we've had, whether it's 2001, the dot-com bubble, or 2008, the financial crisis. When we've reached higher inflationary times and interest rates are high, that cycle down for rates to come down is quite drastic. In fact, when you look at every year that this has happened, we're looking at about a 2% reduction in rates historically. So we should be in that 2% rate reduction on this, given where history's been. How long that's going to take? Most economists right now, based on like even information today I'm looking at, they're looking at about 12 to 18 months. That's quite quick, right? So if you could weather the storm right now of a higher rate and a variable rate mortgage, you'll have more opportunity to lock into a fixed rate when the time is right, because you don't want to early lock in. You want to make sure you get that lower cycle. And based on how many mortgages are coming up for renewal in Canada, like there's 900 billion of mortgages in the next 3 years coming up for renewal. 900 billion. So the forecast is that
that's like 7 Elon Musks.
God. It's true though, right?
Yeah.
So when you look at it, most economists are saying now we're actually going to be down to these 2.5% rates in the next 2 years.
Do you think there's any concern that because clients are contractually obligated to renew with their current provider, because that's going to be their only option? So example is, I'm coming out of my 5-year fixed, I'm with TD Bank, I can renew with TD Bank without having to requalify, but if I want to move away from TD Bank, I'm going to have to requalify with another lender. Is the TD Bank using that to their benefit? Are they saying, okay, you can requalify, but you have to lock in at 3 years, or you have to lock in at 5, and they're not offering other products at that point?
You know what, Rick? It's a great point, and this is what's happening. So we're actually seeing things that I've never seen historically, and I've been doing this almost 3 decades. So I've seen where
you started when you were 3?
I was going to say that. Yeah,
that's amazing. Wow, you're brilliant.
I'm going to say I started when I was 10, when my parents.
There you go. Perfect.
But it's interesting because I'm seeing renewals not being offered to clients that have AAA credit and no delinquencies with the bank. Yeah.
And how can the bank do that without what is the consumer's protection in this scenario?
It's not.
Nothing.
You know what it is? I think what it is it's going to take an individual to go to the media, which will happen.
No, sure it will.
Yeah. For sure it will. They'll absolutely do it. But I have a client of mine that had over $1 million mortgage and never missed a payment and wasn't offered a renewal. So you couldn't requalify them because the rates are so high, and with the yeah, it was tough. I was able to do it, but we had to do a lot of restructuring that they didn't want to do. So
sure.
Or they're being offered a specific rate and term, and that's it. And then I'm also seeing where they're offered a renewal, but the rates are higher than where the rates are.
And that's what I'm asking. Are the banks taking advantage of the situation?
Exactly. Yeah. Right. So it's pushing people into potentially moving and going into our alternative space, which is higher interest rates because they've got higher qualification guidelines and they've just got credit and aren't qualifying on stress tests. So it's moving people into our alt space or our private space. Like our private mortgage space in Canada has increased exponentially. I can't tell you how many privates I've been doing. When I started in this industry, that's what I was doing. It was just where we were at that point.
But your privates are going to be 8%.
Oh, more than that.
More than I know. I'm going back a few years, but yeah, I'm sure your privates are going to be crazy.
So if you're looking at a first right now, probably like 9 to 11%.
You're in Mexico terms now.
Yeah.
That's not good. It's terrible.
It's not good. And if you're looking at a second, you're looking at between 13 and 15%. I know. Wow. So, and here's the other thing too. There's people that are coming up for renewal that can't weather the payment shock, right? Yeah. Payments have increased $300 or $400 and their just budget doesn't allow it, but they can't leave their house because, Wendy, as you know here, the values they're slowly creeping up, but not to what we lost. They need a roof over their head.
Yeah.
We need to do a second privately to be able to help them offset the payment and weather the storm for another 6 months until this correction hopefully adjusts, right? Like I'm telling you know what, the thing is rates can come down 100%. Like, and I know that well, I'm 100% accurate here that I know rates will come down. But what needs to happen to cure what we've gone through in the last 2 years with inflation is we need to see exponential growth on values in certain areas of Canada, specifically Ontario. And why I'm saying that is because we have a lot of mortgages that are still in variable rate products. And there are variable rate mortgages in Canada with banks where the payment never adjusted. So that as bank prime went up, people's payments didn't go up. They stayed the same.
So they're in a balloon scenario?
So the balloon is that they're basically, their amortization has exponentially
they've gone out 40 years.
So instead of being like 25 years when they got their mortgage, I'm seeing right now, I have one that just came to me this week, 147-year amortization.
Oh my goodness.
Wow.
Well, talk about leaving something for your kids, eh?
Isn't that nice? I didn't know that was a thing. Oh my God.
I never heard of that.
It is.
Wow.
So you're renting. You're renting from the bank.
So my basic thought is, and again, correct me if I'm wrong, because I've been out of it long enough, but I believe the maximum is 25 years in Canada, or is it 30 years?
It's 30.
It's 30. But you are allowed to get into a scenario on a variable where they can, instead of increasing the rate, they can just increase the term?
Well, it's not normally, but we have a normal environment. Like we've never seen an environment like this where we've had rates increase like 2,000% in 18 months, right?
Yeah.
Like, and the banks didn't know how to handle it. So what they did is instead of having a bunch of clients, hand in their keys,
default,
and default and walk away from their homes, they said, okay, we're going to just sit on the sidelines right now. And hopefully this market will be, what our governor of finance said is inflation's transitory. Well, hopefully, this will be transitory in terms of this variable rate product and things will go back to normal. But that's not the case. Like what's happening is that when these mortgages come up for renewal, when you're in a variable rate mortgage that is not adjusting your payment and you come up for renewal, the rule with the banks are you have to go back to a 25-year amortization, right? Maybe 30. It depends on the situation, right? Like it depends if it's insured. If it's an insured mortgage, you can't do 30 years. You have to do 25. So if you're at 147, then this is an extreme case. If you go to 25 years, like who's going to be able to manage that payment? So a couple of things are going to happen. One is they're going to come to a mortgage broker. We're going to have to look at alternative products that do 55, 60 years. You'll still have a payment shock, but at least you can stay in your home. And hopefully like these values, which they will increase over time. Or we do a private, or I call the new refinancing is selling your home and buying again with less money down. Right? Because you're basically,
but if the market's softening, you're going to lose. You're now in a scenario where you're going upside down on the value of your property.
Yeah, you might lose. That's right. You might lose, and I've seen it. Like we're starting to see it. So it's the slowness of so many different scenarios of the hit of inflation and we said like the government overshot on increasing bank prime. Like they increased too
Way
fast,
too drastically.
too
Yeah.
quickly. But
This sounds like a problem that's really going to affect your more recent buyers, your last 3 to 5 year buyers who have no equity in their property, don't have the ability to refinance in the value of their home to be able to create themselves into a better finance situation. But anyone who's bought in the last 3 to 5 years, especially when they're buying at the peak of the in the early 2021, they're in trouble.
well, you remember it's 60%. 60% of Canadians. Like, Wendy, how many properties how many clients did you help buy an investment property or their owner occupied property in the last 3 years?
No,
Right?
absolutely. Yeah.
It's massive. So this is, historically, yes, there's trends, but there's not a trend on what happened in 2021. What the fallout is will be it'll be interesting to see what the government does right in the next year in 2024. And we have to remember, like, what's another elephant in the room on this is we've got an election coming up, a federal election in 2025, right? The government's going to want to look like a hero, right? So they're going to want to make sure.
So they're going to drop the rates, I would assume.
Exactly. So it's kind of interesting. Like they overshot on rates, but they've got an election coming up. Right. So timely that rates are going to come down. Who's to say, right?
So many moving pieces. A couple things I want to hear from you. First of all, before I ask my next question, I know a lot of people watching, listening, might not be familiar with the difference between what impacts borrowing rates for fixed versus what impacts rates like up and down for variable. I know I used to just think it was the same thing. I used to think inflation just affected everything. And it's been in working with you and your team that I have learned that there's different things that affect the rates. Can you give a brief explanation of that for people who don't know the differences?
Yeah, no, it's a great question, Wendy. And it used to be a lot more simple for me to be able to explain it to people because the economy was more simple. We're just not in simple times, but they correlate very differently what dictates bank prime and fixed rates, yet it does come back to inflation, right? So overall, it does come back to where inflation is, but it also, and one thing I like to educate people on is it's not just Canadian inflation. Our biggest driver is the US economy, right? And US inflation. So I always say, if the US sneezes, we get pneumonia, right? So it could be a good thing or it could be a bad thing. So sometimes what's good for the US is actually bad for us and vice versa.
Considering my location to the United States, you're lucky to be getting pneumonia because we're on the bottom side.
I think we should just move where you are.
It's not nearly as pretty down here when they get sick. Let me just say that. Yeah.
We don't have the beautiful weather at this point here to look at, or the ocean. Yeah. But so let's go with fixed rates. So fixed rates are very much correlated to bond yields in the US, right? And so bond yields are correlated to the overall economy in the US. So every day, well, I shouldn't say, but most days there are different numbers that come out from the federal government in terms of where the manufacturing is in the US. So where we are at with like retail sales and building permits and gas prices, right? And where food prices are. So all these other variables that are really metrics for inflation, it's not every day, but there's certain days that these numbers are announced so that the government can take a look and see how the overall economy is doing in the US. And this affects our bond yields. And our bond yields are how our fixed rates in Canada are priced. So if the bond yields go up, and it could be a negative driver that's affecting bond yields going up. So one is retail sales. So if there's too much consumer confidence and people are just spending money, which we've seen this year in 2023, that's causing bond yields to continuously spike up. It's one of the major drivers right now of inflation in the US, and that causes our fixed rates to go up. So we've seen fixed rates go up quite a bit this year in Canada. Now, we're starting to see consumer confidence. I'm looking at coming down in the US. The US is actually starting to go into recession. So that is bad news, but it's good news for us in Canada because bond yields are starting to come down. Like we've seen some bond yields drop in the last 2 weeks. And so why we've seen fixed rates come down 50 basis points. So
Mhm.
it's hard for, I'm not going to say average Canadians, but just people that aren't in the know of looking at the different economic drivers of what affects inflation on a day-to-day basis. It's going to be hard for them to understand. Like there's a
Mhm.
stat out there right now that 64% of Canadians don't understand inflation. Well, I don't blame them if they're
Mhm.
not looking
Yeah.
at it every day. And it is
Sure.
complicated. Like even the most
Yeah.
savviest of economists, which I've talked to and listened to, say this market is very unpredictable,
Mm.
right? Because
Mm.
there's so many
Mhm.
different drivers. If one day if it's not retail sales, it could end up being, which a lot of it tends to be, is gas prices, right? Where's
Right.
the price of oil right now, right?
Yeah.
So
Yep.
there's so many different drivers of that. Government debt is another big one. And so those are the factors that drive fixed rates. Now, if I
Right.
look at
Mhm.
Bank Prime is a metric of actually inflation and core inflation. So GDP, CPI, which is consumer price index, and that contributes to, again, all the factors that I talked about, like where we are with oil prices, where we are with mortgage interest.
Mhm.
So interest rates, actually in Canada, mortgage interest affects our inflation rate by 30%. 30%. So it's hard to really break down, but the
Yeah.
higher the rates go on bank prime, the more interest we're paying. That
Right.
ends up being inflationary, yet they want
Right.
that rate to go up so that inflation comes down. So it's very confusing, right, for
Right. See
people,
Rick's
right?
Right.
face? Yes.
So
That's
the main thing
It's the chicken or the egg story.
it is
They said,
100%.
yeah.
But
yeah.
the main thing for people to look at is if we're seeing inflation coming down, that
Mhm.
will indicate that the government will either pause and not
Mhm.
increase or decrease bank prime or
Mhm.
start reducing it.
Mhm.
Now, we've gone from 8.1% in
Mhm.
inflation last year in June in 2022 to
Mhm.
3.1%
Right.
today.
Yeah.
The
Mhm.
target rate, and everybody needs to know this, for inflation, whether you're in the US or Canada, is 2%.
Hmm.
Okay, that's the target that the government needs to meet. So they will do whatever it takes to get to 2%. And the forecast, so I'm looking here at Trading Economics, which is a great link to take a look at. It's a
Mhm.
great tool, it's a great app. And you can look at every country. It talks about all of the forecasts and it breaks it down by Q1, Q2, Q3, Q4, all right, for next year. So they're saying inflation is going to be at 2.5% by Q4 of next year, which is great news. So
Mhm.
they're expecting bank prime to come down a full percent by the end of the year. If I look at the US economy, it's interesting because they're saying that inflation is going to be at 2.6%, so slightly higher than ours, not much by the end of the year of
Mhm.
2024. But their Fed rate will only go down by a half point. So they're going to be a little bit more stickier. And I think that has to do with so much consumer spending in the US,
Mhm. Mhm.
right? So
So I know you
How
are
do
the
how do you sleep at night, Tracy?
I
With
know.
all this going on in your head, that would
you know
be.
what? I'm
No.
a very different person because I love economics. I
Yeah.
love to understand because it helps me. Hopefully, it helps me break it down to a point where people can understand it because it is very complicated, and it helps me
Mhm.
understand how to deal with the market better. If we're in it, we need to deal with it. We have to know it, right? So, and I also have a husband who's extremely savvy on inflation and does speaking right across the country on it. So we kind of debate on this stuff. So it's our go-to.
Give
Dinner
us
table conversations are very
Yeah,
different
exactly,
than at my house. Absolutely. Yeah.
exactly.
give us some hopeful good news, some potential silver lining.
Yeah.
Because I'm
So
sure here's
here's
the
huge.
thing. The
Yeah,
media totally slants negative. I think we can all
100.
agree on that. They're always, crying wolf, the sky is falling, all of those things. So people are already hearing that.
Yeah,
So, where can people kind of be a little bit hopeful, cross their fingers for where things could be going?
yeah. And I'm scrambling it because I want to look at what I just saw today. There was a great article that I saw today. Let me just grab it here. Oh my goodness, I have all these spreadsheets up. You guys would actually laugh at me right now. Um, actually, I'm going to get it up on my phone because I have it here on my phone.
No worries. Take your time.
One second here.
While Tracy is looking, I didn't get to officially introduce or welcome
No, we
Tracy.
just started, didn't we? Just went boof.
We we went from like 0 to 100, just like that, which is awesome. But we are very excited to have Tracy back with us on another
Mhm.
episode of Timbits and Tacos. Tracy, for those who don't know, is an award-winning mortgage broker. She's the founder and CVO of Valko Financial. And I think if people have been listening already, they would understand why it's so helpful to work with you or your team,
Yeah.
because there's just so much to know. It's, mortgages, financing, it's more complicated than it's ever been.
Yeah.
And so people really need an expert, somebody who understands all the ins and outs of the business to really help them, and especially in times like this. So thank you. I know you have a super busy schedule, just keeping up on all of the changing information. So we love having you.
Thank you.
Yeah, because you just have so much great information to share. So
Oh,
thanks.
thank you. Thank you, Wendy and Rick. I really appreciate being on here as well. Listen, educating people, making sure there's some calmness and clarity and, peace that, we will recover. And I think that's the biggest news that I'd like to tell people is this will get better. The worst is over in terms of rate hikes, in terms of inflation. We are on the downward trend, which is a good news.
Hmm.
It's
Yeah.
just going to be an interesting ride how
Yeah.
quickly values go up. We have to remember, like in 2019, the population growth wasn't, we doubled in 2020 to where we are currently now in 2023. We never kept up with the housing supply.
Hmm.
So, any type of small adjustments on rates to help bring that consistency and clarity of that rates are coming down and there's some normalcy again,
Hmm.
the heightenedness of the amount of activity we're going to see in this housing market, and Wendy, you and I can attest to this here, is actually going to be more felt because there's more people looking for housing,
Yeah.
right?
Yeah.
Yes.
So the government has a better pulse now on this because we know back this year and was probably April, May, we were a busier market. And that was just with a 0.25% reduction on bank prime. They literally, the government squashed that and increased bank prime and slowed the market. But when you look at it historically this year, we've only had a 0.75% increase in bank prime. It's because we felt it the year before.
Hmm.
And these increases are lagging effects, which means we really don't feel it as an economy for about 60 to 90 days. So even the last two hikes we've had, our economy isn't even feeling it yet. This is why I
Hmm.
truly think that we'll see rates come down quicker because look at what's happening right now. Mortgage delinquencies going up by 26%. Loan arrears, credit card arrears has gone up 36%. Okay. So people are feeling it because they're getting tapped out in this market because it's very
Hmm.
expensive to live. But kind of going back to what are the wins right now? Well, the
Hmm.
wins are in 2024 and beyond, it's all about decreases on fixed rates and bank prime. So that's a huge win, right? In fact, we're looking at potentially, potentially the first maybe end of Q1, beginning of Q2, potentially the start of a 0.25% decrease in bank prime. So this is good
Okay.
news. This is
Hmm.
good news,
Yep.
right? This is
Yep.
going to help
Hmm.
people that have been sitting on the sidelines. Let's find out how much you qualify for, right? Wendy, let's take a look at, there's a lot more inventory in the market, so it gives people options and choices. Let's
Yep.
really get you into the market because as quickly as we're seeing this moderation right now and conservativeness with clients, it's going
Hmm.
to quickly uptick and people are going to
Yep.
start buying like this. And if you don't get in, you might lose out on that value that you can get to in today's market. So I think that's a
Hmm.
huge win. I think
Yep.
that's
I
it.
would agree
That's
completely. Yes, absolutely.
Hmm.
yeah, that's it. That's a huge win. And it's interesting because there's this article, and this is why I brought this up. David Rosenberg is an economist that was one that when the financial crisis hit in 2008, prior to that, it was about a good 12 months prior to, he's the one that actually forecasted it when really nobody was saying, like, what are you talking about? This isn't going to happen. He actually did. So he's put out a post out there. Now, again, it's the media heightened with the title of this caption, but he says Rosenberg sees terrifying mortgage math bringing Canada rates down quickly. So what he's saying is that basically the Bank of Canada hasn't done their due diligence and learning that they've overshot on rates
Mm.
and not seeing how many mortgages are coming up for renewal because of the
Mhm.
housing activity we had over the last 3 years. And he's expecting that the Bank of Canada will be forced to cut 2% rates off of the policy rate, which is the bank prime rate. So that's bank prime
Okay.
in the next 12 to 18 months, taking it down to 3%. Okay. So he says if we don't see this US housing crash that was in 2008 is going to be nothing compared to what the Canadian economy will feel. Now, that can be scary, but you got to remember the government's already forecasting some rate decreases already. So they know it's there. And this is
Mm.
why I say what goes up comes down quite quickly.
Mhm.
And I do think this wave of mortgage renewals is sort of a blessing for us because the Bank of Canada is going to be forced to do the right thing, which is decrease
Mm.
rates.
Mm. Mhm.
Yep.
Mhm.
Right. So people that are coming up for renewal or looking to buy, you need to make sure you have your team right now getting in touch with a mortgage advisor,
Mhm.
getting to know your numbers in today's market, which is
Yep.
worst case scenario, will help you better off down the road as these rates come down and help you position how to do your mortgage. Because to your
Mhm.
point, we might have to do a variable rate, we might have to do a short 1 year term, maybe a two.
Yep.
It just depends on where you're at with what you qualify with.
How far out should people begin the process? So if they have mortgages renewing in what, like 6 months? What
So believe it or not, I'm telling people if you're in the next 3 years, you need to call now.
in the next 3 years? Okay.
Yeah, you need to call now. And why is because I really don't think as an economy we're financially savvy enough to weather the storm of rates even going up at
Mhm.
whatever year it is.
Mhm.
Knowing your numbers now help you prepare and help you budget better, right? So,
Mhm.
and
Mhm.
it also prepares people if they need to sell in the next year or two. Um, you got to get your ducks in a row, right? So I do think you need to contact at least 3 years. But if you don't, specifically if you're up for renewal in the next 12 months, you need to call today.
Okay.
Yeah.
Mhm. Yep.
And Wendy, I think this is going to be a very interesting time for us as real estate agents, especially in Canada. We're a little different down here, but
Mhm.
right now you're rolling into a buyer's market.
Mhm.
But I think there's going to be a very short window on that buyer's market
Yeah.
just because there's such incredible demand for property.
Yep.
So as a buyer's market, you've got this opportunity to say, hey, listen, you might have to lock in at a percentage or two higher than you would have liked to,
Mhm.
but your house value is lower than what you would probably
Mhm.
pay 6
Mhm.
months from now. Because
Yep.
we're going to see as soon as these rates begin to get down a quarter, a half, a full percent,
Mhm.
uh, we're going to slip out of that buyer's market and back into a seller's market very
Oh,
fast, and
Very
prices are going to go through the roof again.
Yeah,
Mhm.
So
Mhm.
that's kind of what I'm from this conversation. That's kind of what I'm piecing together.
I do. Yeah,
Yeah.
I do truly believe, knowing now that that 2.5% rate is realistically going to happen at some point, this 2021 year that we had that someone said, oh, we would never see this again. I think we will see it again.
Yeah.
I do.
Mhm.
And I think it
Mhm.
will be potentially mid 2025, but definitely probably 2026. I do think we'll see that year again. It's inevitable with there's not enough housing initiative from the government on every level, municipal, federal, provincial, to be able to keep up with the demand needed for the amount of population growth we've had, right? And ultimately, a lot of people that are coming into our country, their dream is to own a home. That's it,
Yeah.
period. End of
Mhm.
subject. Have a good life, own a home, bring my family here.
Yep.
And they'll do whatever cost it is to be able to get that. And there's not enough supply. So they will do whatever it takes to get a property. And that will drive up values. And I think it's honestly uncontrollable for the government because they can't artificially keep rates up if inflation is down to where it needs to be, right? And they will do that 2%, right? Like they'll make sure federal government makes sure it'll be at 2% when they're coming up for election in 2026 or sorry, 2025, because they want to get back into play again, right? So
Mhm.
there's so many, like it is a sensitive time. It's interesting. It's interesting in a better way than where we were this year. Does that make sense?
Mhm.
Yeah.
Mhm. Yeah.
I think this is a very this actually excuse me, this actually builds off the conversation that you and I had about a month ago, Wendy. We were
Mhm.
talking about the markets and what's going on, and
Yeah.
this is another driver in that conversation that we didn't even get into.
Right. Yeah. No, absolutely. I know, and I was excited today to get the news that that inflation has come in a little bit lower than what they were projecting.
Yeah,
So that's a good
it's
sign
a good thing. Yeah.
that we're
Very
headed in the
cool.
right direction.
Yeah,
Very
no,
cool.
So,
absolutely.
is there anything else that you think would be helpful for people to know? Answer that, and then I'll ask you where people can find you and your team. But
For sure.
first,
I think it's people really need to understand their budget and their numbers. I think more than ever before. Um, really being able to budget well in this very difficult time of higher inflation, you'll you'll come out stronger in so many aspects. First of all, a lot of people have been able to, you know, quite quickly become a minimalist on stuff that they don't need or
mhm,
costs they don't have to spend, right? If they actually took the time to look at what they spend on a monthly basis. So I think changing a bit of lifestyle is always good to some extent because people are saving money where they can.
yep,
Um, and being able to weather the storm of this inflationary time and come out, you know, ahead or even it is a big accomplishment. And we all need to take pride in all of us being able to get through this. When we just came out of a pandemic, like we haven't even been able
mhm,
to breathe out of a pandemic. And then we got hit
right.
with inflation. Like, have we actually really celebrated that? I
Yeah,
don't think
I
we
know.
have, right?
Yeah.
So, and Wendy, like you're very much in tune with, helping people holistically as well. I think there's a
Mhm,
lot of trauma
mhm,
in that, and there's a lot
mhm,
of trauma in money. So, I'm very passionate about that people need to celebrate the wins. And this is a win coming out
mhm,
of this,
mhm.
knowing where you are with your money, even not spending money on, going out and getting coffee every morning could save like $3,000 a year, right? On your budget.
Yep.
We have to be a little bit more savvy, I think, with our money. And this is definitely, if anything, lessons for us, it's all of us to do that and do it better. Because when there's good times, which are coming,
Mhm.
you might still be more conservative. And that way there, you'll learn from this
Yep.
that there will be another time like this down the road. Like it's not just going to be the one off, right?
Yep.
We're going
Yep.
to see this again, whether it's in 10 years or 20 years. So we can weather it better because we remember how this felt the pain of it, right?
Mhm,
And I think that's it is making sure you're connecting with people that can support you and educate you on financial literacy, coming up with a budget, knowing your numbers, speaking to
mhm,
a mortgage professional, realtor, just to see where you're at with your house because life can bring you unexpected challenges.
mhm,
And
mhm,
our health system already is hurting in Canada.
mhm,
So I'm
mhm.
finding that people may have to move because it's better for them from a wellness perspective, from maybe they need to seek medical attention and have to change, because they can work remotely from home. You need to know your numbers just because you don't know what tomorrow is going to bring. And I think that's really the big lesson I tell everybody right now.
Yeah, yeah. And
Cool.
your Valko Financial, you have, in addition to just helping people with financing and mortgages, I believe you have some type of like a budgeting or like teaching program or course available.
Yeah, so we actually have a couple of tools, especially during
Okay.
these times. I thought it was really important to come up with a mortgage program as well. We have a mortgage assistance program. So it's
Okay.
alternative options for people that are coming to a point where they just cannot meet the payment shock or getting the assistance with their existing lender. We're here to be able to give you options and choices, extended amortizations, reduction in payments, debt settlement programs as well. If you're over leveraged, there's a lot of tools we put in this so that people can still come out of this not as weathered, right? And that
Mm,
they have the
mhm.
support. But we also have
Yep.
our credit coaching program. So it's
Mhm.
teaching people, a lot of people don't understand what a credit score is or what
Yeah.
affects it, right? So
Yep.
and I don't blame people. It's just not something that's in our educational system. It's slowly coming in there.
Yep.
But as you know, Wendy, like through the years of schooling, we never really had that, right?
Oh,
So our kids didn't have it. Even our kids, like my youngest is 22, and I'm teaching her stuff because it still isn't in the systems, let alone
yeah.
in the universities. So, teaching people from kind of that start to finish and supporting them, and there's accountability measurements is something
Mhm.
we're super passionate about, right? Helping people stay into, a home that they've worked so hard for and the dream of home ownership. I'm super
Yeah.
passionate about. Like, this is why we got in the business, right?
Yeah.
Helping people, having a house is a privilege to have, but it's
It
also a
is.
right for us in Canada that we should be able to do that. So giving people a strong foundation, I think is a huge passion for me.
Mm-hmm.
Very nice.
So where can people find you? So they've been listening and either want help with kind of that credit coaching or some initial conversations. Maybe they're coming up for renewal, or maybe a new home buyer that actually could potentially qualify and want to take advantage of the, lower prices right now.
Yeah,
How should we find
absolutely.
you?
Well, I mean, I'm pretty active on social media. So my name's not that common. My last name, Valko, Valko. You look it up. I probably am one of the first ones that pops up.
Yep.
There's many, many Valkos in the world. But so it's Tracy Valko is my Instagram, I guess, tagline. My email address is tracy@valkofinancial.ca. You can find me on LinkedIn, Instagram. You can email me. Talk to you, Wendy. You can send them over,
You're all over the place.
all over
Yep.
the place, right?
Yeah. Yeah.
Very cool.
Anything else, Rick, before we let
No,
Tracy get
I
back
just
to?
thank you, Tracy. You're always an educational moment for me, and I appreciate that.
Yeah,
Thank you, my
absolutely.
Yeah, this is awesome.
Absolutely.
It's always a privilege to come on and support you guys, but also like support the community, right? Let them know where things are going
No,
on. And I'm
yeah,
excited
Yes.
about coming back because who knows where we'll be in end of Q1, Q2, right?
Yeah.
Hopefully
Yes.
lower, right?
Yeah. We'd love
absolutely,
a really, really positive update.
Exactly. And we
totally.
got spring market coming. Think about
I
that. We'll
know.
be done the winter in no time, right?
Exactly. Exactly.
Cool.
Well, thanks again.
Thank you.
And we like to wrap up our show by saying adios
And goodbye.
and goodbye.
Thanks, guys.
Thank you.